Welcome back to the deep dive. You know that kind of unsettling feeling you get sometimes when the financial headlines just seem relentless. Maybe it's general economic uncertainty, or maybe you remember things like the bank failures back in 2023. It really makes you stop and wonder, doesn't it? When it comes to my investments, where is my money really safe? So today we're doing a deep dive into an organization you probably see mentioned, maybe on your brokerage statements, but it's often misunderstood. The Securities Investor Protection Corporation, SIPC for short. Now, I bet for a lot of people, the first thought is, oh yeah, that's like the FDIC, but for investments, right? And well, there's a tiny grain of truth there on the surface, but the differences are really crucial. So our mission today, let's cut through the confusion. Let's clarify what SIPC actually is, what it really protects, and how it works as basically a safety net for your investments.
Absolutely. Think of this as getting you up to speed on a really vital part of your financial security setup. We want you to feel informed, empowered, not bogged down in jargon. And we'll dig into some surprising stuff too, like how SIPC gets its funding, what kinds of losses it definitely does not cover, and interestingly, how you might actually have more protection than you think. I expect a few aha moments along the way.
Okay, let's start there then, with maybe the biggest misconception.
Mhm.
People hear federally mandated, and the mind immediately jumps to, like, a government agency. Is SIPC just another branch of the federal government?
Yeah, that's a really common assumption. It's the first big thing we need to clear up. SIPC is not a government agency. Yes, it was mandated by the federal government through an act of Congress back in 1970, the Securities Investor Protection Act, or SIPA. But it's actually a private nonprofit organization.
Private nonprofit. Okay.
Right. And its mission is very specific. It's there to protect investors against losing their cash and securities if their member brokerage firm fails financially, goes
Yeah.
bankrupt, basically.
So it steps in when the broker itself is in trouble.
Exactly. It's a safety net for that specific scenario. It's not a regulator watching over them day to day. And how it's funded is interesting, too. It comes entirely from fees paid by its member broker-dealers.
So not taxpayer money.
Correct. No taxpayer funds involved. SIPC has its own reserve fund. It's pretty substantial, around $4.4 billion right now. And it technically can borrow from the U.S. Treasury if needed, but impressively, it's never actually had to do that in its entire history.
Wow, okay. So private nonprofit, federally mandated. What does that mean for its powers, or maybe lack of power? It isn't regulating brokerages, right? It's not investigating them. If something looks fishy, that's still the job for the SEC and FINRA.
Precisely. That's another critical distinction. SIPC has zero regulatory power, no investigatory authority. Think of it as reactive. It steps in after a firm is already hitting the skids financially, not to prevent it. Its sole job is protecting the investors when that failure happens. And they've had a fair bit of work over the decades. Since 1970, SIPC has handled about 330 brokerage liquidations. In that time, they've helped return over $140 billion in assets to more than 773,000 investors. That's a pretty solid track record.
330 cases since 1970.
Yeah, and what's also interesting is that they haven't actually initiated a new brokerage failure case since 2017.
Oh, really? Since 2017?
Right, which might suggest, maybe increased stability or perhaps more effective oversight from the actual regulators, the SEC and FINRA, preventing firms from getting to that point.
Okay, that history is somewhat comforting. Now, let's get to the core of it, what I think everyone really wants to know. What is covered? What's the headline number? And what does that coverage actually practically mean?
Right, the specifics. So the standard coverage limit is up to $500,000 per customer.
$500,000.
But that's for the total of your securities and cash held at the brokerage. And within that $500,000, there's a more specific limit for just cash.
A sublimit.
Exactly. Up to $250,000 for uninvested cash sitting in your account.
Got it. $500 K total, max $250K of that in cash.
Correct. And here's the really crucial concept to grasp. SIPC protects the custodial function of the brokerage.
The custodial function. What does that mean in plain English?
It means SIPC makes sure you get back the assets, the stocks, the bonds, the cash that the brokerage was holding for you, the stuff that's legally yours, kept separate from the firm's own money.
Okay. So it's about getting my stuff back if the place holding it collapses.
Precisely. It's about the safety of the assets entrusted to the firm, not about guaranteeing the firm's own financial health or its investment picks.
Okay, that leads perfectly to my next question. A really common worry, I think. Let's say I invest in a stock and it just tanks. Or maybe my advisor gives me some really bad advice and I lose a bunch of money. Does SIPC cover those kinds of losses? Because, people feel their money wasn't safe then either.
That's a critical point, and the answer is a clear no.
No.
SIPC absolutely does not cover losses because the market went down. If your investments lose value due to market volatility, well, that's just the inherent risk of investing. SIPC isn't market insurance. And importantly, it also doesn't cover losses that result from bad investment advice. If you followed advice and it didn't pan out, SIPC isn't going to make you whole.
So what does it cover then, specifically?
It covers the loss of your cash and securities only if it's due to the brokerage firm failing or because of theft or unauthorized activity. Think about something like a Ponzi scheme, like the Madoff case. That involved outright theft of client assets. SIPC stepped in there.
Right, because the assets were supposed to be there but were stolen.
Exactly. Or, say, if your broker made trades in your account without your permission, essentially stealing from you. If those actions lead to a loss of your securities or cash because the firm can't make it right, maybe because it collapses, then SIPC protection could apply. It's tied to the failure of the firm to protect what you entrusted to them, or outright fraud leading to the firm's insolvency.
Okay, that clarifies it a lot. What about specific things that are definitely not covered?
Yeah.
Any common assets or situations people should know are outside SIPC's protection?
Yes, there are several important exclusions. Things like commodity futures contracts are generally not covered unless they're in a very specific type of account. Foreign exchange trading, Forex, that's not covered. Fixed annuities aren't covered. Certain types of investment contracts, like limited partnerships, typically fall outside of SIPC protection too.
And the big one these days, cryptocurrency.
Ah, yes, crypto. Explicitly not covered by SIPC at this time.
What?
The main issue is legal and regulatory definition. Under the law that created SIPC, protection applies to securities and cash. Most cryptocurrencies haven't been legally defined as securities in a way that fits the SIPC statute. That would likely need a court ruling or even an act of Congress to change. So, for now, a secure crypto held at a brokerage is not SIPC protected.
The Madoff case you mentioned. That's such a stark example. SIPC applied because it was theft, a failure of that custodial duty.
Exactly. It was incredibly complicated, of course, with things like clawbacks and trying to figure out actual losses versus fictitious gains. But the core principle was that SIPC, along with the court-appointed trustee, worked to recover assets and return them to investors based on the money they originally deposited, up to the limits.
It also seems to highlight something important for us as investors. What should we be doing?
Absolutely. This brings up your role. SIPC is a backstop, but personal diligence is key. Read your account statements carefully, regularly.
Don't just file them away.
Right. If you see anything that looks wrong, a transaction you don't recognize, a discrepancy, don't wait. Document it. Call your firm immediately. Ask questions. Complain formally if necessary. Especially for unauthorized transactions, acting promptly is crucial if you ever need to make a claim down the road.
Good advice. Okay, so we know the standard coverage. $500 K total, $250K cash sublimit. But what if you're fortunate enough to have, say, $1 million or more invested? Does that just mean anything over $500,000 is hanging out there unprotected? Or are there ways to structure things?
This is probably one of the most valuable aha moments for people with larger accounts. You can often get significantly more than $500,000 in protection at a single brokerage firm.
How?
Through what's called separate capacities or different ownership capacities.
Right.
Basically, if you have different types of accounts at the same brokerage, SIPC treats them as separate persons for insurance purposes, each getting its own $500,000 limit.
Okay, give me some examples.
Sure. Let's say you have your own individual brokerage account. That's one capacity. Then maybe you also have a traditional IRA at the same firm. That's a second separate capacity. And maybe a Roth IRA, too. That's a third separate capacity.
So each of those individual traditional IRA, Roth IRA, gets its own $500K limit at the same broker.
That's right. In that example, you'd have potentially $1.5 million in coverage, $500 for each, at that one firm for those three accounts. Other common examples of separate capacities are things like joint accounts, say with a spouse, trust accounts like a living trust, corporate accounts, accounts for a minor under UTM AGMA, estate accounts. Each different legal ownership structure usually counts separately.
That's huge. But what's the catch? There's always a catch, right?
Well, the crucial caveat is this. Multiple accounts of the same type in the same capacity at the same brokerage are not insured separately. So if you just open two regular individual brokerage accounts, both in your name at the same firm, SIPC lumps those together. They share one $500,000 limit between them.
Got it. So two individual accounts at broker A equals one $500K limit.
Yeah.
But an individual account and an IRA at broker A equals potentially two $500K limits.
Exactly. And just to add another layer, if you have an individual account at broker A and another individual account at broker B, those are insured separately because they're at different firms.
Okay, that makes sense. So understanding these different capacities, these ownership types, that's really the key for anyone with significant assets to maximize their SIPC coverage.
All right, let's shift gears slightly. Let's imagine the worst does happen. Your brokerage firm is failing, maybe going out of business. What's the actual process? How does SIPC get involved?
Typically, it starts with a heads up from the regulators, the SEC or FINRA. They notify SIPC that a firm is in serious financial trouble and likely can't meet its obligations to customers. If SIPC agrees that the firm's customers need protection under the SIPC law, they'll go to a federal court and ask for the firm to be put into liquidation.
Okay, court involvement. Then what? The court appoints a trustee. This is usually a lawyer who specializes in this kind of thing, although for smaller, simpler cases, SIPC itself might act as the trustee. The trustee's job is basically to take control of the failed firm, figure out who the customers are, what assets they held, and start the process of making them whole.
How do they do that? Send checks.
Sometimes, but the preferred route, the ideal scenario, is actually to transfer the customer accounts directly to another healthy brokerage firm. SIPC works with the trustee to try and arrange this quickly and smoothly. That way, customers just get access to their accounts again at the new firm, often quite fast. This happened for many customers after Lehman Brothers collapsed in 2008. Their accounts were transferred and valid claims were fully satisfied.
So transfer is plan A. What if that's not possible?
No. If a direct transfer can't happen, maybe because the firm's records are a mess or assets are missing, then customers have to go through a claims process. They'll get claim forms, need to provide documentation of what they held, and the trustee, backed by SIPC funds up to the limits, will distribute the recovered assets and SIPC money. That's more like what happened with Madoff, a long, complex claims process.
And you mentioned SIPC has recovered billions in the Madoff case.
Yes. Working with the trustee, they've clawed back funds and distributed them. Initial deposits up to $1.7 million were fully covered, and other claimants have gotten back about 71 cents on the dollar so far, with potentially more to come. And for really small, straightforward failures, SIPC might just do a direct payment procedure, bypassing the formal court process.
It sounds like there's a defined process, which is reassuring. But you also mentioned earlier that new cases haven't happened since 2017. What usually happens before SIPC even needs to step in? Are there other layers of protection?
Absolutely, and this is important context. In the vast majority of situations where a brokerage firm runs into trouble, it doesn't actually end in a SIPC liquidation.
Oh, what happens instead?
Often, the firm might arrange its own orderly wind down, or more commonly, it gets acquired by a stronger competitor. In those cases, customer accounts are just transferred over to the acquiring firm as part of the deal. It's usually pretty seamless for the customer. They just get a notice about their new custodian.
So mergers and acquisitions often prevent the need for SIPC intervention.
Exactly. Plus, there are fundamental regulatory requirements designed to prevent disaster in the first place. Brokerages are required by law under SEC rules to keep customer securities and cash segregated. That means your assets must be kept separate from the firm's own operational money.
Segregation.
Yeah.
That sounds important.
It's critical. They also have to meet net capital requirements, meaning they need to maintain a certain level of liquid assets. So because of segregation and these capital rules, even if a firm fails, and even if your account balance is over the $500,000 SIPC limit, there's still a very high probability you'll get all your assets back. The system is designed to protect customer property first.
Okay, that segregation rule adds a significant layer of comfort, especially for larger accounts. Now, we've danced around it, but let's draw a really clear line. SIPC versus FDIC. We hear FDIC all the time, especially, as I said, after those bank failures. How are they fundamentally different?
Great question, because the names sound similar and the purpose feels similar, but they operate very differently. First, the FDIC, Federal Deposit Insurance Corporation, is a U.S. government agency. Full stop.
Government agency. Okay.
And it actively regulates the banks it insures. It has examiners, it looks at their books, it has deep insight into their financial health, and it can step in proactively if a bank looks shaky.
Right. We hear about the FDIC taking over banks sometime.
Exactly. Now, SIPC, as we established, is a private, nonprofit membership corporation funded by the brokers. And crucially, SIPC has no regulatory power. It doesn't examine firms. It doesn't have that inside look into a brokerage's financial condition.
It relies on others for that.
Entirely. It depends on the SEC and FinRA, the actual regulators, to monitor the firms and flag any that are in danger of failing. SIPC only gets involved after the regulators sound the alarm.
So different structure, different powers, and protecting different things.
Precisely. FDIC protects bank deposits, your checking account, savings account, CDs held at an insured bank. SIPC protects security stocks, bonds, mutual funds, and cash held at a member brokerage firm specifically against the failure of that firm or theft of those assets.
So different institutions, different assets, different protectors.
You got it. Two distinct safety nets for two different parts of your financial world.
Okay, so for you listening, the big takeaway here is knowing which shield covers what. Your bank savings, likely FDIC. Your investment portfolio, likely SIPC. Different buckets, different protections. All right, wrapping this all together, what should you, our listener, do? If you have a problem with your broker, what's step one? And if you have assets over that $500 K limit, what's the practical advice?
Okay, if you think there's a problem, an error, an unauthorized trade, anything suspect, step one is always call your brokerage firm directly, talk to your advisor or their compliance department, try to resolve it there first, document everything, of course.
And if that doesn't work?
Then you escalate. You file a formal complaint with the regulators. Both the SEC and FOINARA have straightforward online portals for submitting investor complaints. Provide all your documentation.
Okay, makes sense. Now, for the bigger accounts, over $500 in one capacity.
If you find yourself exceeding the $500,000 limit for single ownership capacity, like just in your individual account at one brokerage, the most straightforward way to ensure full coverage is, well, you have a couple of options. You could move the excess amount to a different type of account at the same firm, if that fits your needs, like funding an IRA, if eligible. That creates a new capacity. Or you simply move the excess funds or securities to an account at a completely different brokerage firm. Spreading assets across multiple firms is a common strategy for high net worth individuals.
So use different capacities at the same firm or just use different firms.
Exactly. Understanding those ownership capacities we talked about, individual, joint, IRA, trust, etc., and using them strategically or diversifying across institutions, those are your main tools for maximizing protection beyond the basic $500 K limit.
Excellent. So today we really dug into SIPC. We clarified it's this federally mandated but private nonprofit safety net. We saw its crucial role is protecting you if your brokerage fails or if there's theft, importantly, not against market drops or bad advice. And we uncovered those really interesting nuances about coverage limits and how separate capacities can significantly expand your protection.
Yeah, and fundamentally, knowledge is power here, isn't it? Understanding how SIPC works just helps you make smarter, more informed decisions about where and how you hold your investments. It adds a layer of confidence.
So here's something for you to think about. Now that you have a clearer understanding of SIPC, its limits and those ownership capacities, what steps might you want to take? Maybe reviewing your own accounts, just ensuring your assets are structured for the fullest protection possible. Thank you for joining us on this deep dive into SIPC. We really hope it sheds some light on this important, maybe sometimes overlooked piece of the financial system. Keep asking questions, keep seeking that deeper understanding. We'll see you next time.